Normally, stocks in the same sector trade together, and stocks in the same industry trade almost in lockstep. But every so often, you get an abnormal situation where the stocks of two extremely similar companies take off in opposite directions, like we're seeing right now with Uber and Lyft. For months, these two ride-sharing plays were the poster children for everything wrong with the IPO market in 2019. Uber and Lyft both came public in the spring with incredibly disappointing action right out of the gate. They both tried to rally over the summer. They both broke down in August, and they both kept falling until mid-October. Last month, though, both stocks started rebounding from their lows. After an initial flirt with Lyft, I have to tell you, I've been very bearish on these two, so I wasn't sure what to make of this move. Dead cat bounce, legitimate bottom. Given that these ride-sharing outfits are exactly the kind of growth names the market turned against over the summer, ultra-fast growers that are a long way from turning a profit, I didn't care to speculate. Didn't seem worth it. But a funny thing happened over the past week. Lyft reported a decent quarter last Thursday, and then Uber reported an ugly quarter on Monday. All of a sudden, these two stocks that had been trading together for months and months and months are now moving in opposite directions. Lyft's hanging in there while Uber's breaking down. And when you take a closer look, I think they could keep moving in opposite directions. Yep, I'm pessimistic about Uber's prospects right here because they're committed seemingly to lose money, particularly because of Uber Eats. But Lyft could be worth another look. There's no Lyft Eats. I'm going to tell you why. First of all, it's worth noting that the two ride-sharing kingpins were already disentangling themselves when they reported in August. The last time we got results from Lyft, it actually shot the lights out, smashing Wall Street's expectations. With bountiful revenue growth, impressive cost controls, spectacular guidance, including a narrower-than-expected loss versus last year. And suddenly I started thinking, maybe it's not just a glorified cab company. While Lyft's stock jumped 3% the next day, that's where it peaked, though. Why? Well, some of it's because that's where the market turned against the hyper-growth names, but mostly I think it's because Uber reported a couple of days later, and Uber's numbers were much more mixed. Wow. The top dog posted weaker than expected sales, even as its earnings were better than feared. The lesson of the last quarter is that Uber's a lot more complicated than Lyft. Wall Street doesn't like complication. It's got a sprawling international business. It's not a pure play on ride sharing thanks to Uber Freight and Uber Eats. And its shipping and food division, I have to tell you, the Uber Freight, just so you know, the freight business went down. Uber Freight business did well, but the rates went down for all freight. Now, the stock got hammered on the news. It's plunging from 43 to 33 over the next week. And then the pin action dragged down Lyft, too. Then, with the rotation out of growth, both stocks spent months getting hammered. Until 4 weeks ago, when they turned around, started running into earnings season. From October 10th to October 30th, Uber rallied 18%. Lyft pole vaulted 24%. What happened? In this case, I think it was positive pin action from Lyft, pulling Uber back up. See, Lyft came public in March, and the lockup on insider selling expired a month early. On August 19th is when it happened. That's another reason the stock got hammered over August and September. You had a massive quantity of previously restricted stock hitting the market. But by the time mid-October rolled around, most of the insiders who wanted out, well, they had already sold. They'd gotten rid of a major overhang. Then 2 weeks ago, Lyft's two senior-most executives spoke at a Wall Street Journal event, telling investors that the company's earnings before interest, taxes, depreciation, and amortization would turn positive by the fourth quarter of 2021. The analysts who followed the thing hadn't even been dreaming of profitability within the next 2 years. In response, the stock caught a wave of upgrades and price target hikes. Wall Street has no patience for unprofitable growth plays right now. But a growth name that has a clear path to profitability, well, that's a different story. So Lyft stock roared. Uber rode its coattails. Which brings us to last Thursday, when Lyft reported yet another excellent quarter. The company delivered higher than expected sales, up 63% year over year, very high of the companies I follow, with a much smaller than anticipated loss, a 28% increase in active riders, 27% increase in revenue per rider. Management's guidance for next quarter was extremely bullish. Once again, they raised their full-year forecast. That's phenomenal. Look at this. This is what you're looking for, right? It's what I'm looking for. Here's how CFO Brian Roberts put it on the call. Quote, when we reported Q2 back in August, I described second quarter sales and marketing leverage as truly exceptional. Well, sales and marketing leverage in the third quarter was truly, truly exceptional, end quote. What about cost containment? Here I'm quoting again. As a percentage of revenue, sales and marketing was 16% in the first quarter versus 41% from the same period a year ago, representing a decline of over 60%, end quote. Holy cow! Wow, they're running a good company. Roberts said they made it happen by, quote, taking advantage of the healthy market environment to reduce coupon incidence and drive operating leverage, period, end of story. I just got a huge coupon, by the way, for Uber. I don't know if you got it, 50% off. Someone said to me the other day when I made a wrong decision in fantasy football, they said, you've been Ubered. In short, for the second quarter in a row, Lyft knocked it out of the park. Sure, they're still losing money, but they've made major strides to get costs under control. Management's promise to deliver positive EBITBA by the end of 2021 now sounds incredible. However, because the stock had already run into the quarter, it initially bounced just 3.4%, ultimately finished the session down 6%. I'm calling that profit taking. Now, when Uber reported on Monday, messy. While their sales and earnings were stronger than anticipated, gross bookings disappointed again, and both monthly active users and total trips were a little soft. The biggest negative was this Uber Eats, the online delivery service. We know the industry is in horrible shape. Just last week, the biggest player in the space, Grubhub, had a total meltdown after management told investors that they were going to earn far, far less than anyone expected as the industry's gotten way too competitive and the diners have become promiscuous. Yes, the promiscuous diner. I've been looking, it's open 24/7. Don't get me wrong. Uber's also making major strides toward profitability. I'm giving them that. Management believes they can start breaking even in 2021, too. I'm giving them that. But the stock still got obliterated yesterday, down nearly 10% before losing another 4% today. Why? In addition to all the hair on the quarter, Uber's lockup on insiders selling expired. The company's got 1.7 billion shares outstanding. About 1 billion of these shares just became tradable today. A lot of speculation that because it's under, a lot of people are underwater, they wouldn't sell it. Oh, come on. They sell it when they think it's going lower, and they buy it if they think it's going up. Remember, Lyft got obliterated by its lockup expiration over the summer. I wouldn't be surprised if Uber's just having the same experience. Although I was gratified that it didn't go down much more than it did. The bottom line, it's still way too early to go bottom fishing at Uber. The market's being flooded with supply here. It's going to clear up, but that's what's happening. Lyft, not only is its lockup expiration already in the rearview mirror, it's now reported 2 terrific quarters in a row. And that's why I think Lyft is finally worth buying here. We should have Lyft on the show because we like them and they've been on. But because of its lack of profitability, let's be clear, it's just for speculation or for young people who use it instead of buying cars. Greg in Ohio. Greg.
Hey, Jim, a big Columbus, Ohio booyah to you and go Brownies.
Yeah, why not? Okay, what's up?
I was just wondering what your thoughts on the stock Livongo Health is, ticker LVGO.
We like this. We like it a lot. I know it hasn't been that good, but we were actually thinking, we were speculating if Tim Cook were in an acquisition mood, well, you would be a buyer of it, but he's not. Still, I think it's a good situation. Right, typically, stocks in the same sector trade together, but every so often you get a situation like we saw in Uber and Lyft. Lyft is a buy right now. Uber, not so much. Okay, there's much more mad money ahead, including my sit-down with First Horizon CEO. What does its merger with Iberia Bank mean for you if you're a shareholder? Do not miss my exclusive. Then hypergrowth stocks can't seem to get any respect in this market. I'm explaining why with one that I think is critical to this entire market. You probably never heard of it. An order calls Rapid Fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.